Hello there. As we're coming in the webinar room today, I want to welcome you. My name is Marche. I'm the webinar director here at Advice Chaser. Before we introduce our guests and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. The presenter will answer those queries during or after the presentation today as appropriate. If you ask a question in the chat box, go ahead and leave your contact information as well. And if we can't get to your question during today's presentation or question and answer period, we're happy to make sure someone reaches out to you after today's event to address that. Again, we want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material, and we're here to educate today. I'd love to introduce you to our moderator today. Mark Seither is a partner and wealth manager with Kingsview Partners in Knoxville, Tennessee. He has a Bachelor of Arts in Economics from San Diego State University and began working as a financial advisor for Northwestern Mutual in La Jolla. Mark enjoyed finding innovative solutions to clients' complex problems, and his desire to work with the entrepreneurial-minded helped him thrive as a financial advisor. As Mark honed his skills as an advisor and planner, he looked for a platform that would better pair with his desire to work with clients needing advanced planning and specialized fixes. And he found his spot back in Northern California in early 2017 when he joined Trust CFO and assisted in integrating complex tax and estate planning with wealth and investment management. Since then, he is paired with Josh Saunders, his business partner, and together they work with individuals on wealth management and tax strategies. And we're so excited to have you back, Mark. And go ahead and come off of mute and say hello to our attendees.
Hey everyone, really excited to be on today with Joseph Luna. As anyone who has been on any of my past webinars, I stress the importance of tax strategy. Tax strategy is such a key part to financial success. So I'm always looking for experts in certain areas, always looking for good information, and really excited to dive into today's topic with a guru on opportunity zones, Joseph Luna.
All right. Well, I'd love to introduce Joseph. Joseph Luna Esquire is the managing partner of OZ Invested. I don't know if you pronounce it OZ Invested or Oz Invested, Joseph.
I go by OZ, but as we discussed earlier with Oz, that's how people always review to the language in the statute. So either is fine.
All right. It specializes in opportunity zone investments. Joseph's ability to analyze complicated areas of the tax code and develop creative solutions allows him to thrive as an opportunity zone attorney. Joseph created OZ Invested to provide clients a firm designed to manage every aspect of their opportunity zone investment. Joseph applies his knowledge of business taxation to help clients determine their optimal investment structure and helps clients create their qualified opportunity fund and qualified opportunity zone business. After capital contributions occur, Joseph utilizes his expertise in data analytics to advise the clients on potential opportunity zone investments that would thrive if added to the area. Upon acquiring the property, Joseph helps clients make deferral elections and ensure opportunity zone investment compliance. Joseph also provides clients with an opportunity zone investment simulator, which allows them to test performance and compliance under any scenario. When it's time to sell, Joseph utilizes his expertise in M&A taxation to help clients determine a sales structure that maximizes returns. And Joseph, I'm going to go ahead and turn the time over to you. We're excited to have you present.
Thank you, Marche and Mark, and welcome to today's presentation on Opportunity Zone investments and strategies. So opportunity zones are generally a little known piece of tax legislation that were passed back into law as part of the 2017 Tax Cuts and Jobs Act and codified in Code Sections 1400C1 and Code Section 1400C2. So during today's presentation, whenever you hear the term opportunity zone, always be thinking census tract, and each state can designate up to 25% of their qualifying low-income census tracts as opportunity zones eligible for investment. Currently, there are over 8,700 census tracts located throughout the United States that have been designated as opportunity zones. And as you can see on this map, every area that's been highlighted in, looks like purplish, is an opportunity zone census tract. And so they are literally found in each of the 50 states. The island of Puerto Rico is actually almost entirely an opportunity zone. And they are generally scattered between urban and rural communities. So if you ever wanted to see specifically whether a property you were looking at was in an opportunity zone census tract, there are numerous maps available on the web that will allow you to just type in your address and see specifically whether one of those addresses falls within any of those purple census tracts designated as an opportunity zone. So what makes opportunity zone investments such a big deal are the tax incentives. So any taxpayers with existing capital gains who reinvest capital equaling their capital gains into an opportunity zone investment can do two pretty important things from a tax perspective. First, they'll be able to defer paying capital gains tax on amounts invested until December 31st, 2026. So say, for example, if I had $1 million that I bought an asset for, and then that asset grew in value to $3 million, at that point, you would be able to defer paying capital gains tax until 2026 by making the opportunity zone investment. Now, the second tax incentive is perhaps the most significant. And so opportunity zone investments held for at least 10 years can be sold completely tax-free from a federal tax perspective. And you also too are able to avoid having to recapture depreciation upon your exit. So it really can be an absolute game changer for an investor who utilizes the opportunity zone tax incentives, because I challenge anyone out there to really go out and see if they can find any other tax conscious investment strategies that literally allow you to sell completely tax-free after 10 years. So if you were to say invest $1 million into an opportunity zone investment and it grew in value to call it $10 billion, you could sell it for $10 billion without having to pay any federal capital gains tax. It truly provides you unlimited tax-free growth on your opportunity zone investment. So to break down specifically how an opportunity zone investment compares to the non-opportunity zone investment in terms of your overall return, let's just look at the simple example. So on the left side, we have the opportunity zone investment, and on the right side, we have the non-opportunity zone investment. So in this example, we will assume we bought an original investment for $1 million, and then at that point, the investment was sold several years later for $3 million. So as you can see, you'll have a $2 million capital gain. And this capital gain concept, as you will see, is critical to the opportunity zone investment because it's one of the requirements for you to actually qualify for these tax incentives that we will be discussing here shortly. So as you can see in both investments, you will have, in this case, a $400,000 capital gains tax. Now, the difference between the opportunity zone investment and the non-opportunity zone investment is that your capital gains tax for the opportunity zone investment won't actually have to be paid until December 31st of 2026, with you writing the check then on April 15th of 2027, whenever you go and file your end of the year returns. Now, for the non-opportunity zone investment, you will pay your capital gains tax in 2022 in this case, as you otherwise would if you sold the asset today, just because there wouldn't be any special tax incentives that qualify you for the ability to go and defer paying capital gains tax. And that's really one of the, as I mentioned previously, significant tax incentives offered by the Opportunity Zone legislation, that ability to defer paying capital gains tax until 2026. And then, as you can see, if you were to go and look at the actual present value you create with this tax savings, in this case, that's going to be about approximately a $35,000 just tax savings by the ability to defer having to pay capital gains tax. So at the end of the day, you'll ultimately still have to pay your capital gains tax on the original investment. You'll just end up paying it later in both the Opportunity Zone investment and the non-Opportunity Zone investment. But again, you'd be able to potentially invest the amount you would have to pay in capital gains tax this year into other investments, and then just know that you'd have to go and write the government their check for $400K, but you've had the ability to go in and actually grow that money while you've been having the ability to defer paying capital gains tax. So again, that's the first tax incentives, and it does create some value for you. Now, the second tax incentive, as you can see on this chart, is the most significant. So in this case, we'll be looking at our reinvestment into the Opportunity Zone investment. So our investment purchase price in this instance is going to be the $2 million we had in those capital gains under the previous slide. So in this case, we'll say we had our $2 million in capital gains from the sale, and we took those $2 million and invested it into an Opportunity Zone investment. And then we'll say in 10 years at an 8% return, that investment is now worth $4.3 million. So in this case, we would have $2.3 million worth of capital gains as a result of our exit in 10 years. Now, as you can see, the Opportunity Zone investment wouldn't have any capital gains tax, whereas the non-Opportunity Zone investment would have $460,000 approximately worth of capital gains tax that you'd have to pay. So that's a pretty significant tax savings just by actually making the Opportunity Zone investment. I mean, you have almost $500,000 in total in tax savings alone, just by actually utilizing the Opportunity Zone tax incentive. So anytime you can ever keep more money at the end of your investment, it's always something that's wise to consider. And the Opportunity Zone investment allows you to do just that. So as you can see here in our breakdown, kind of have how it all stacks up, it's really something where whenever you're looking at your total after tax return, the Opportunity Zone investment creates some tremendous value for you. And Opportunity Zone investments can quite frequently, as you will see later, be done as you wouldn't even necessarily have considered them originally, just because you now have learned about these investments and know how to actually structure them properly from the outset, even though you would have done the project originally without the Opportunity Zone tax incentives implying. So it really can be a big deal. And just looking at these tax savings generated, I mean, approximately $500K, in additional tax savings generated through the Opportunity Zone legislation. And not only are you generating tax savings, but as you've seen in our previous slides with regards to the census tracts, you will be redeveloping communities, creating new businesses, and ultimately improving the quality of life for everyone in the community. So these investments really are almost a win-win for both you and your investors, as well as these local communities. But all you have to do is make sure that you structure these investments properly and meet certain requirements in order to qualify for these tax incentives. And also, just going back to that previous slide one more time, I would just note real briefly that after-tax return for the Opportunity Zone investment can only continue to increase. So if we were to sell the assets, say in 10 years for $8 million, you'll have an even larger tax savings. If you were to sell for $80 million, now you're really looking at some substantial tax savings, because again, any amount that you exceed your original investment after 10 years will qualify for tax-free growth. So now we'll be looking at the Opportunity Zone investor requirements. So unfortunately, just by meeting those, or just by making an Opportunity Zone investment, you're actually not going to be able to qualify for the tax incentives unless you then go and meet these 4 requirements as the investor. So the first requirement is that you must be an eligible taxpayer. That means simply that you are a U.S. citizen or an individual who is subject to U.S. taxation, and you can also be a legal entity that's subject to U.S. taxation. All effectively you need to be is subject to U.S. taxation. Now, the second requirement is that you must have eligible gains. Now, there are 4 types of eligible gains. They include both long-term or short-term capital gains, collectible gains, unrecaptured 1250 gain, and 1231 gain. So as long as you have one of those 4 types of gains, you will be able to qualify for the Opportunity Zone tax incentives by making the investment. Now, the third rule is that you must invest your eligible gains within 180 days from the date of sale. So say, for example, today on July 14th, I were to sell some stock that gave rise to some eligible gains. I would then have 180 days from today, July 14th, to go and make my Opportunity Zone investment. Now, the fourth and final requirement is that you must make a valid deferral election. So to make a deferral election, you'll need to file 2 forms with the IRS. The first form is the Form 8949 that you'll file in the year you actually sell that asset that gave rise to your eligible gains. And the second form you'll file is the Form 8997 that you'll be required to file each year you hold on to your Opportunity Zone investment. So always remember, for your deferral election, there are 2 forms to file with the IRS. And once you meet these 4 requirements, at that point, you will be considered an Opportunity Zone investor who qualifies for the tax incentives. Now, if you don't meet any of those 4 requirements at that point, unfortunately, you wouldn't be able to enjoy those tax incentives. So it's always critical to plan accordingly in the event you are looking at making an Opportunity Zone investment, because if you miss one of those steps, say you forget to invest within 180 days, unfortunately, at that point, you wouldn't be eligible. So it's always critical to plan well before you ever make these investments. And the most significant thing you could probably be considering right now is just kind of what the rules are, and start coming up with your own timeline potentially for how you'd be able to comply with these rules in the event you ever wanted to make an Opportunity Zone investment. Now, we'll move into the Opportunity Zone investment structuring piece of today's presentation, and we'll get a little complicated here for tax purposes, as I like to say, but ultimately we will try to make this as simple and concise as possible. But the Opportunity Zone rules have literally almost 6 pages of statute, and then I want to say almost 800 pages of regulations. So as you can imagine, there's a lot that goes into these investments, but we will get you through, I would say, probably the most significant material that would just provide you the framework you need to actually consider structuring an Opportunity Zone investment in today's presentation. So as you can see, there are 2 general structures. The first is having a qualified opportunity fund invest directly into qualified Opportunity Zone business property. The second is to invest into a qualified opportunity fund that then invests into an Opportunity Zone business, and then having that business go and acquire qualified Opportunity Zone business property. And if these terms sound foreign to you, that's totally okay. It took me 6 years of my life to learn them myself. So now we can kind of go through one by one, specifically what all these terms mean, and then bring it back full circle to those structuring slides that we just looked at. So the first key term is qualified opportunity fund. So a qualified opportunity fund means an investment vehicle organized as a corporation or a partnership for the purpose of investing in qualified Opportunity Zone property, and that holds at least 90% of its assets in qualified Opportunity Zone property on its applicable semi-annual testing dates. So qualified Opportunity Zone property includes 3 types of assets, and it's ultimately going to be the critical asset for your qualified opportunity fund to acquire, because in order to actually meet that 90% qualified Opportunity Zone property requirement, you must have effectively any of these 3 types of assets. So the first type of qualified Opportunity Zone property asset includes stock in an Opportunity Zone business. The second type of qualified Opportunity Zone property asset includes partnership interest in an Opportunity Zone business. And the third type of qualified Opportunity Zone property asset includes qualified Opportunity Zone business property. So if some of these terms sound familiar, it's because we discussed them briefly on our structuring slide. So as you can see, kind of how the structure works is that you'll have your qualified opportunity fund receive its capital from the investors, and then you will have ultimately your qualified opportunity fund go and acquire qualified Opportunity Zone property by acquiring qualified Opportunity Zone business property or acquiring stock or partnership interest in the Opportunity Zone business. And as you will see here briefly, whenever we talk about the Opportunity Zone business rules, qualified Opportunity Zone business property comes in as one of its tests. So, your qualified opportunity fund has one test, that standard 90% qualified Opportunity Zone property test, But in the event it elects to invest into an opportunity zone business, well, in order for the qualified opportunity fund to actually pass its own 90%, it must make sure that the entity it invests into as an opportunity zone business meets its own 5 tests. So as we discussed, qualified opportunity zone property includes 3 types of assets, and one of those or 2 types of those assets or stock or partnership interests in the opportunity zone business. Now, in order to be considered an opportunity zone business, the business must meet 5 tests at the end of each taxable year. First, at least 70% of the tangible property owned or leased by the business must be qualified opportunity zone business property, which we'll discuss next. Second, at least 50% of the total gross income for the business must be derived from the active conduct of the business in an opportunity zone. Now, to meet the second test, you can generally look at where your employees are working based upon their number of hours worked or amounts paid to the employees. And the test will be met if at least 50% of all hours worked or amounts paid to employees are for services performed in an opportunity zone. So say I'm going to go and construct a new warehouse in an opportunity zone and operate it as part of my trade or business. Well, as long as I have all my employees working within that warehouse facility, I will then meet the 50% gross income test under either the hours worked or the amounts paid test, or safe harbors, sorry. So the third opportunity zone business requirement is at least 40% of the intangible property of the business must be used in the active conduct of the business in an opportunity zone. The fourth opportunity zone business test is that no more than 5% of the average of the aggregate unadjusted basis of property held by the business may be attributable to non-qualified financial property, which includes things like cash, stock, partnership interests, options, futures contracts, warrants, annuities, debt instruments, and other types of cash equivalent assets. And number 5, your business can't be a certain type of business known as a sin business. And sin businesses include things like golf courses, country clubs, massage parlors, hot tub facilities, suntan facilities, racetracks, liquor stores, and casinos. So whenever you're looking at whether your qualified opportunity fund has invested into a business that meets these requirements, well, the business will be required to go and test compliance with these 5 tests at the end of each taxable year, and it must meet all 5. So it's always good to plan accordingly well before you ever look at actually structuring one of these investments to ensure that the business entity you are constructing will be able to meet all these 5 requirements in order for your qualified opportunity funds investment to then go and be considered an opportunity zone business, because at that point, the business had met these 5 tests. So qualified opportunity zone business property is a term that we've actually used several times already. And perhaps it's probably, I would say, one of the more complicated terms, but we will get through this together. So qualified opportunity zone business property means tangible property used in a trade or business that meets the following 3 requirements. First, it must be acquired by purchase from an unrelated party after December 31st, 2017. And so for purposes of looking at relatedness, you will look to code sections 267B and code section 707B, which include a long list of related party transactions. But effectively, what these transactions will prevent you from doing is buying property from a family member or from another business you own, or even from yourself, because they really want you to be making new capital investments into these opportunity zone communities and not trying to skirt around the rules to get investment you already own to now qualify for the opportunity zone tax incentives. Now, the second qualified opportunity zone business property requirement is an either or. And it's the only either or test, I would say, in the entire opportunity zone statute. So to meet the second requirement for qualified opportunity zone business property, the property can be either original use or you can substantially improve the property. So put a pin in this for now. We will move to these in the next 2 slides, but just know the second test is this either or original use or substantial improvement requirement. Now, the third requirement for qualified opportunity zone business property is that during substantially all, meaning at least 90% of the holding period for the property, substantially all, meaning at least 70% of its usage occur in the opportunity zone. So you got to love the actual regulation sometimes, because they'll have substantially all mean 2 different percentages in the same sentence. Like, I don't know who actually put that together. It's a really kind of unique concept, because I've never seen any other area of the tax code have specifically substantially all mean 2 different percentages in the same sentence, but that's the way that this works. And so to actually meet your third requirement, I would say, it's really good to kind of think of this as its own 2-part test. And the first test asks, okay, during this applicable testing period, am I using the property in the opportunity zone at least 70% of the time? If the answer to that test is yes, great, move to step 2 and now ask, okay, for at least 90% of the time that I've actually owned this property, have I met this 70% use test? And the answer to that test is yes as well. Great, you meet the third requirement. If the answer to that is no, unfortunately, you're going to fail the third requirement. So the real purpose of this third qualified opportunity zone business property requirement is so that property actually remains in the opportunity zone. They don't want you to go buy, say, an asset like a jet and have it be, completely new property that you're actually not using in the opportunity zone at all to go and improve the quality of life for the citizens. So the great news is for a real estate asset, you will always meet your third requirement because the property is only in the opportunity zone. It can't be used anywhere else. But then thinking back to our 70% qualified opportunity zone business property requirement for our businesses, potentially, there could be some issues. Say if I wanted to go and start like a drone imaging company, and say, for example, that drone imaging company would be a really expensive drone that we'll be using outside the opportunity zone to go survey customers. So again, you'll always kind of have to break it down on a asset by asset, business by business basis to make sure that you'll always be able to exceed the 70% threshold in light of this third requirement that effectively requires the property to be used in the opportunity zone for at least 70% of the time, for 90% of the time that you own it.
Now, Joe, we had a question come in kind of on the last slide about those I think you said the sin categories, the
sin businesses, correct?
Yeah, sin businesses. Someone asked if cannabis was included in that, and I don't know if that also fails the 90-70 because maybe 90% of it's in the thing, but 70%, more than 70% is smoked outside. I have no idea.
So it's only looking at how the asset's treated as your balance sheet.
Okay.
Cannabis actually raises a very interesting question. So the sin businesses I described were actually passed into law by Congress back in the 1980s. So the theory that cannabis at the 1980s would ever potentially be considered a legal business is like arguing that cocaine distribution would be considered a legal business, or bank robbing would be considered a legal business. So because of that, there has been a lot of discussion amongst opportunity zone tax attorneys about cannabis businesses. This is actually probably one of the top 3 most common questions we ever get. And our gut tells us that specifically until it's legal under federal law, you probably can't actually have a cannabis business be considered an opportunity zone business. And just the simple reason is because although it's not actually defined on the list of sin businesses, again, neither is bank robbing. And if you and someone were to go start a bank robbing business at that point, obviously it's illegal under federal law, but it's not on the list we just described. So I would honestly wait until it's probably going to be removed from the schedule that the federal government utilizes to criminalize activities, just to be safe. But I can say cannabis is definitely something that potentially could be an opportunity zone business. It's just really something, though, right now, I always err on the side of caution whenever we're looking at these rules, because there has not been hundreds or pages of case law about specifically what you can and can't do, because it's still such a new statute, with the opportunity zone rules only being finalized, the final regulations themselves, in 2019. So we haven't had really any case law determine specifically, what types of activities are considered sin businesses, maybe outside of the scope of the ones that are on the list. And I would just say until you can have a definitive answer, yes or no, it probably makes sense to sit on the sidelines, because right now, these investments, as you can see, they're quite complicated. And in the event you met all 4 of the other requirements, and then the IRS were to say, you know what, no, we really think that cannabis is a sin business, at that point, it could potentially make your opportunity zone business no longer compliant.
And here's a good way to think about that too, is if you're looking at that example of the $2 million, right, and you're saying like, hey, we got a capital gains tax of 0 or a capital gains tax of 463. The cannabis is basically a $463,000 gamble at that point, because you'd hate to retroactively be like, well, I guess I'll, who do I make that check out to again?
Yeah, exactly. And imagine if it's $30 million instead of $4 million.
So we will see as the smoke clears on the cannabis topic. Yeah, that still has to be hashed out, not to squeeze too many puns in there.
That was well done, Mark.
Thank you.
All right, let's move on to the business property.
Sure. So qualified opportunity zone business property, as I mentioned, has that either or test, with the property being either original use or substantially improved. So in order to meet the original use requirement, the property must be placed in service for purposes of appreciation or amortization in the opportunity zone for the first time by you. So let's say, for example, I was buying some vacant land and I'm going to go and construct a new building upon that land. So at that point, I'm going to be the first one to place that new building in service in an opportunity zone for purposes of depreciation or amortization, and therefore it will be considered original use. Now, similarly, I say on my slide, test applies if land has no existing buildings or vacant buildings. It's most common to always kind of think about opportunity zone investments around land, but remember, qualified opportunity zone business property applies to all types of tangible property and not just land or real estate. So you could also have original use assets, say such as a brand new truck or a brand new piece of equipment that you just purchased and are now the first one to appreciate in the opportunity zone. So the core, I would say, of this is that really you're looking at whether you are buying assets and then placing them in the opportunity zone for the first time that anyone has done so in an opportunity zone. So that is the original use requirement, and that's one way to meet the second qualified opportunity zone business property requirement. The second way to meet the second qualified opportunity zone business property requirement is to substantially improve the property. So again, this is for a real estate investor commonly thought of as buying land with an existing building. So in order to meet the substantial improvement requirement, during any 30-month period beginning after the date of acquisition of the property, additions to basis of the property must exceed an amount equal to the adjusted basis of the property at the beginning of the 30-month period. So real estate investments are unique because you will be able to exclude the value of the land from your beginning of the 30-month period number. So a good way to kind of think of this is just through some simple examples. It's going to be crystal clear after we go through a couple of these, I promise. So let's say we buy a piece of real estate for $1 million and we allocate $700,000 of the purchase price to the building and $300,000 of the land. Well, in order to substantially improve the property, we must make at least $700,000 worth of improvements to that building and do so at the beginning in a 30-month period. Similarly, let's say we buy a piece of real estate for $400,000 and we allocate $300,000 of the purchase price to the existing building and $100,000 of the purchase price to the land. Well, then, in order to substantially improve the property, we must make at least $300,000 worth of improvements to that building and do so in a 30-month period. One more time, let's say we buy a piece of real estate for $5 million and we allocate $2 million of the purchase price to the building and $3 million of the purchase price to the land. Well, then, in order to substantially improve the property, we must make at least $2 million worth of improvements to that building and do so in a 30-month period. So whenever you're looking at your substantial improvement requirement and whether you meet that threshold amount, you can also make sure you include your capitalized costs, which I've noted here on the bottom. It's a relatively long list, so I won't go through them all one by one, but they can be counted towards your substantial improvement requirement. So, the one other thing I just wanted to note briefly on this slide is, remember, this is a relatively easy test to consider with regards to a real estate investment. But let's say instead I am buying a piece of equipment from a business located in the opportunity zone. Well, if that business is located in the opportunity zone, unfortunately, it's not going to be considered original use because at that point, someone's already placed it in service. So I'd be required to substantially improve that equipment. Now, how do you go about substantially improving a piece of machinery? Your guess is as good as mine, but technically that rule would apply. So keep that in mind as well. Now, again, bringing it back full circle with our opportunity zone investment structure, your qualified opportunity fund's always going to be the gateway to your opportunity zone investment. This is literally the absolute core requirement of your opportunity zone investment, no matter what you'll be looking at doing, because your capital gains or those other eligible gains you have will always first go directly into your qualified opportunity fund. And from there, your qualified opportunity fund has to hold 90% of its assets in qualified opportunity zone property. And effectively, there really are two ways for you to acquire qualified opportunity zone property, as we discussed. First is to invest into the opportunity zone business. Second, you can acquire qualified opportunity zone business property directly and operate it as part of your qualified opportunity fund's own business. So bringing it back to that original structure we discussed, structure one or structure two, now the question's obviously going to become, okay, which one of these is really going to be optimal for me? And so that's kind of a nuanced question that always depends upon what you're doing. But I would generally say that structure number 2 is by far going to be the most common, just because of the amount of flexibility you have by actually operating an opportunity zone business, say with the ability to hold less amounts of qualified opportunity zone business property than you would if you were to own it through your qualified opportunity fund. So we'll provide you next with a nice little step-by-step breakdown so you can kind of see just how these investments actually work in practice. So step 1, you create your qualified opportunity fund. Step 2, you sell your property with capital gains. Step 3, you invest the proceeds from the sale equaling the amount of your capital gains into the qualified opportunity fund with 180 days to make your deferral election. Step 4, your qualified opportunity fund now creates a qualified opportunity zone business. Step 5, you then have your qualified opportunity fund invest the amount of capital you just contributed into that opportunity zone business. Step 6 will then be having the qualified opportunity zone business acquire qualified opportunity zone business property. Step 7, your opportunity zone business will then operate a business that meets the 5 tests. And as long as it does so each year, your qualified opportunity fund will have its 90% qualified opportunity zone property requirement met, because its entire investment into that business of its stock or partnership interest will be considered qualified opportunity zone property. And then step 8, your investor who invested their eligible gains will now have to go and recognize their capital gains tax, with their tax payment being due actually in April of 2027 with their timely filed returns. And then step 9, after 10 years, you can have your qualified opportunity fund sell its equity in the QOZB, or it could have its opportunity zone business sell its qualified opportunity zone business property directly in other assets, and then distribute the proceeds back to the qualified opportunity fund, and then have the qualified opportunity fund distribute those proceeds out to the investor tax-free. So it really does provide you some flexible exit strategies, because again, there really kind of are 3 ways to exit your opportunity zone investment and qualify for the tax incentives. Either A, you can sell your equity in the qualified opportunity fund directly. B, your qualified opportunity fund can then sell its equity in its qualified opportunity zone business and liquidate to the investor. Or 3, you could have the opportunity zone business actually sell its assets directly and then liquidate back to the qualified opportunity fund. So I would say the increased flexibility structure we were describing here will apply generally whenever you have your qualified opportunity fund and qualified opportunities on businesses taxable as a partnership. Now, there's some special rules for C corporations that will limit you to actually only selling your equity in the qualified opportunity fund tax-free. And so because of that, it is generally said to be the preferred structure to utilize the partnership taxation structure, because of your ability to actually sell the underlying assets either at the qualified opportunity fund or the qualified opportunity zone business level. So strategies for opportunity zone investments obviously will really depend upon the facts and circumstances unique to your investment in particular. Now, I would say, the most significant strategy you'll ever want to consider is, if you're really serious about opportunity zone investments, stop and think and plan. Don't just go and say, hey, I've seen this property in an opportunity zone, I'm going to go buy it. Because if you do little things like that, unfortunately, you could completely miss out on the opportunity zone tax incentives for that property because you didn't do it correctly from the get-go. So my core, I would say, strategy is always stop and think and plan. I mean, everything else at that point can obviously be corrected in the future, but as long as you always have a plan in place that will allow you the chance to qualify for the opportunity zone investments and make sure you're meeting all the rules along the way, you will be extremely, extremely satisfied. I can guarantee you with just how your investment will go, because it's not going to be any pitfalls awaiting you. And then at the end of 10 years, the IRS won't say, what do you mean, you want the opportunity zone tax incentives? You didn't make a valid deferral election. So it's always just little things like that. Whenever you just stop and plan accordingly, if you think that potentially these tax savings are something you may want to add to your portfolio, it really is something that I can't stress enough how significant it can be. I mean, from an estate planning perspective as well, the beautiful thing about the opportunity zone legislation is that it actually doesn't expire until 2047. So say, for example, you have an opportunity zone investment into some brownstone building that you buy, and you want to then at that point have it be received by your heirs upon your death. So the great news is, because of this program's runway, As I mentioned, you have to hold on to your investment for 10 years, but you're not actually required to sell immediately after hitting the 10-year mark. You actually have any time between the 10-year mark and 2047 in which you can sell that investment and qualify for the Opportunity Zone tax incentive. So it really does provide you some flexibility with your exit. And say, if you were to start an Opportunity Zone business that was in the process of becoming the next Google at that point, well, you wouldn't have to sell before things got really cool. I mean, obviously you have some flexibility between hitting that 10-year mark and when you sell. So, I honestly think with Opportunity Zone investments, which is kind of what makes them really unique, is it's almost just like putting a mask over a regular investment. And so rather than just having your business be subject to normal partnership taxation rules or normal corporate tax rules, you're now implementing this extra level of compliance to be considered a qualified opportunity fund or a qualified Opportunity Zone business in that case. And as long as you meet those requirements, you're now able to offer and enjoy some pretty significant tax incentives. So again, it's not like if you're looking at putting together a brand new startup, call it logistics warehouse, you could obviously do so without putting in the Opportunity Zone, but why not put it in one of these census tracts? And at that point, make sure we're structured appropriately, because at that point, I'll be a qualified opportunity fund and a qualified Opportunity Zone business already doing what I'm doing. So it really is something that it's still a relatively little known piece of tax legislation, but it's only been around since 2017. And if you're not really familiar with these investments, it's not your fault. It's totally, I blame Congress, I blame the pandemic, I blame everyone but the actual investors themselves for not knowing about these investments, because they've really had a tortured birth. And it's been something where when this was passed into law back in 2017, literally all we got was 6 pages. And then we finally got our final regulations in December of 2019. And then by then we actually had already missed almost one of our additional tax incentives, because the way the statute was worded, as you go and look for yourselves in Code Section 1400Z1, there was this additional step up in basis you could qualify for that would even provide you an additional tax incentive, but people were hesitant to make these investments because they really didn't know what they were doing yet. And so finally, when we got the final regulations, everyone was rocking and rolling. Then we had the pandemic. And so now here we are in 2022, and Opportunity Zone investments are becoming more, I would say, well-known amongst the public, but they still are relatively little known in terms of everyone really looking at these investments as potentially a tax trading strategy. So that concludes my portion of the presentation, and I will pass it back over to Marcia.
All right, well, Mark and I have gathered questions from our attendees, and Mark, I'm just going to go ahead and let you address those.
Yeah, thank you. And thank you again, Joseph. And to just back up what he was saying about these kind of having a tortured birth, I was one of those that back in 2017, as an accounting firm, a CPA firm, came to us with a whole bunch of this information, and it was one of those like, well, sounds like you're not giving me much to go off here, right? They only had minimal information. It was like, that sounds great. I don't know where to plug and play this. So it's been it has been an eventual process, a gradual process, getting well versed in them. So I had another question on businesses in Opportunity Zones. One person asked if there's a business in an Opportunity Zone, but the majority of its workforce works remote. Does that affect the inside outside the zone?
Unfortunately, currently it does. Although I would say if your employees are working remote, there's an odd chance that a significant percentage of them could actually just be in an Opportunity Zone. Like I know, for example, my mom's house is an Opportunity Zone, and I lived there whenever I was coming up with my company. So it's kind of something where if you're actually kind of just going down the remote work path, there's potential avenues to mitigate having employees working offsite and still being compliant. One way is to have your executives still working at the Opportunity Zone location, have those executives being paid potentially a higher salary, so you can make compliance with the 50% gross income test under the amounts paid test versus the hours worked test. So, it's not something that's entirely fatal. There's also a third safe harbor that potentially could apply, and that is based upon where your tangible property is located and your business and decision-making functions occurring. That potentially could allow you to meet the second 50% or the 50% gross income test. I'm just always kind of hesitant to rely on that one because no one really knows what the heck it means. And because of that, it's always something where it's like, well, where are we generating our property from? What's our business do? Or where are we generating income from? What's our business doing? Are we having our people working from home, providing services to customers, or are we having the actual tangible property that's housing all those servers that they're utilizing to then go and be the actual way we're generating income from our customers? So it's a great question. And again, I would say, whenever this is passed back into law, remote work really wasn't part of the commonplace. And so this is still a relatively live statute. I mean, we just keep getting correcting amendments. I am hopeful that they will contemplate remote work, but I guess the counter argument is part of the reason they actually have this requirement is because they want people coming into these business locations in the opportunity zone to go work and go have lunch down the street and go park their car and go just be part of this community, not necessarily having everyone working off site. But again, with careful structuring, I would say there probably is a way for you to make sure you can meet your 50% gross income test. It just won't be, I would say, a definite as it would be if you had all your employees just working on site.
Yeah. Okay, perfect. And then another question came in as far as that 10-year period. If someone needed to, let's say they made a $2 million or a $1 million contribution into an opportunity zone fund and needed some of it back early or all of it back early, is it locked up for 10 years or can you take portions out?
Sure. So this is an excellent question. I would say it's something that isn't necessarily going to be completely preventing you from enjoying the opportunity zone tax incentives, but it will also potentially require you to recognize a portion of that gain prior to 2026. So a good way of thinking of it is whenever you make your opportunity zone investment, you hold a zero basis in your investment until you recognize your gain in 2026. Now, at that point, if you invested $1 million, you would be able to go and say distribute 500K out to yourself and still have a 500K opportunity zone investment. But upon recognizing that 500K, because you have the zero basis at that point, you'd be receiving cash in excess of your basis and therefore be required to recognize gain. So you'd be required to recognize the gain whenever you receive that distribution in excess of your basis, but it wouldn't prevent the remaining portion from qualifying for the opportunity zone tax incentives. And it really is something where it shouldn't ever be treated as your own personal piggy bank, but it is always a part of any investment where things change and maybe you don't like the investment anymore. And so the only harm at that point you would have potentially is that you wouldn't be able to enjoy the deferral. And if you take out the entire investment, obviously you wouldn't qualify for the tax incentives and would have to pay capital gains tax on any amounts in excess of your basis prior to 10 years.
Got it. Perfect. And then someone else was asking, what are some, because you mentioned don't just see an opportunity zone or an opportunity and go buy it. What are some red flags as far as like, hey, though this is an opportunity zone investment, maybe it's not a good actual investment?
Sure. So I would say, obviously, if you're doing this yourself versus investing into someone else's qualified opportunity fund, those red flags could be different. And I always encourage people whenever they're doing this themselves, don't do anything you don't already know how to do. I mean, it's kind of like if I know how to go and open up a multifamily residential real estate complex, well, if I want to make an opportunity zone investment, I may want to go and then at that point open up a multifamily real estate complex in an opportunity zone because that's my area of expertise. And so at that point, you're just going to be utilizing your own business acumen to make those close calls about whether an investment's good or bad. I would say you'd actually be pretty shocked if you looked at a map of opportunity zones and kind of just, did some detail about where some of these properties are located, because they're actually in some up and coming or even affluent communities. I know a lot of college towns are opportunity zones because it's looking at where the census tracts data are and how much people in the census tracts make. And well, generally college students don't make a lot of money. So opportunity zones are all over college towns. A lot of urban communities too have, census tracts that extend into affluent areas that still qualify. So properties can be out there. Now, if you're going to be investing into someone else's qualified opportunity fund, obviously you'll need to do your due diligence as any investor would. And that really is something that always kind of, I would say, is going to be a little bit more risky because you're obviously giving someone else your money and saying, hey, give it back to me in 10 years. But I always look for superior knowledge and track record of performance. Those are always the two factors I consider whenever I'd be looking at investing into someone else's opportunities on investment. I mean, A, are you really smart? Do you know what you're doing? And then B, have you actually done it before? And so if you can demonstrate those two concepts, I would feel safe investing with them rather than someone who can't show those two skills. Because again, obviously you'll be riding in someone else's car at that point. You better hope they're a good driver.
Mm-hmm. Yes, and we're having a couple other questions trickle in now too. Someone was asking if, theoretically, if they had a $2 million tax this year, would that be deferred?
So this year, as in 2022, yes, if you had 180 days still, and you were to make all those opportunities on investor compliance requirements to qualify for the tax incentives, you would not have to pay capital gains tax in 2022. You would then defer paying capital gains tax until December 31st, 2026, recognize your gains then, or recognize your gains again then, and then at that point, pay your tax on April 15th of 2027, whenever your timely filed returns are due.
Mm-hmm. Okay, and then someone else was asking for more information on, how do you set up, how can someone set up an opportunity zone fund?
Sure. So again, it's generally going to be something where you'll need to find someone to help you go and create your legal entity, to go and make sure you're structured appropriately with the opportunity zone rules. And you can do it in any 50 stage. You can utilize your personal attorney that you previously worked with, or anyone who knows how to set up entities. And then at that point, you become a qualified opportunity fund by filing a form 8996 with the IRS at the end of your first taxable year, every year thereafter, where you pretty much certify when you became a qualified opportunity fund, and then again specifically identify when you made your investment and what investments you acquired. So it really is a nuanced form, but become a qualified opportunity fund obviously is something that requires some, I would say, consideration of the particulars around you and what you're trying to do, and whether you'll be raising capital because you have all the security requirements to comply with. So it's something, if you're seriously interested in considering, obviously I could talk about this for another 2.5 hours. It would just be really nuanced, I would say, to your particular facts and circumstances, but the general rules are right in front of you. You must be a legal entity that's organized and taxable as a corporation or a partnership for the purpose of investing in qualified opportunity zone property, and that holds at least 90% of its property on the qualified opportunity zone property on the applicable semi-annual testing dates. That's verbatim in the statute. That's code section 1400Z2. And right there, you can see what the actual requirements are. But then whenever you're actually looking at implementing it, that's kind of whenever you have all the legal requirements come into play about how do you set up an entity? How do you become a partnership or a corporation? And then looking through the different strategies to consider, all that are part of the calculus that goes into setting up your qualified opportunity fund.
Do you have a side job of doing the side effects of pharmaceuticals? That last bit, that was rapid fire.
No, sorry, it's funny.
Oh, no, it's great. It's great. No, it's perfect. It's just when you read through that description, it was like that is memorized to the exact punctuation and inflection.
Well, that's the rule.
Awesome.
Yeah. We're impressed, Joseph. We're impressed.
Yeah, no, that was a mark of yes.
You can go back to the slide. The rules there as well for qualified opportunity.
Yeah, and then someone else was just running through an example, because I know there was like the first use, and did you play, was it pre-existing in the opportunity zone before? They're asking, hey, if I were to find a vacant property, rehab it, and then put it into service after it's been vacant all this time, is that original use, and is that going to qualify?
So generally, yes, it's going to depend upon when you're vacant. The vacancy rules, I believe, where it has to be vacant for at least 3 years prior to you acquiring the property. I think it's 3 years, but there's a special rule that has this timing nuance for how long it has to be vacant for. And to the extent that the property is considered vacant, yes, at that point, the property would be considered original use you construct. Now, the other thing is too, you have to think about vacant property as well. And it's like, what your starting base is going to be at anyways. I mean, that thing's probably not going to be worth much, but it would be considered original use.
Yeah. Okay, perfect. And then someone else was asking for just clarification real quick on that 180-day rule.
Sure. So as we looked at the opportunity zone investor requirements, there were 4 requirements. The third requirement is that you must make your investor eligible gains within 180 days. So let's say I sold some Apple stock. I sold the building today. I would have individually 180 days from today in which I must make my opportunity zone investment. So that's effectively 6 months. Now there's a special 180-day exception for gains that arise from a pass-through entity, such as an S corporation or a partnership, that allow you to actually have slightly different 180-day periods based upon when the partnership's returns are filed and the end of the partnership tax year for the entity that gave you those gains, but that's a little more complicated and nuanced. Just know that generally you have 180 days from the day you sell the asset to go and make your opportunities on investment by investing those eligible gains into your qualified opportunity fund.
Yeah, perfect. And just to reiterate, I mean, this is one of those things that takes planning, right?
Exactly.
Because there's something leading up to the opportunity zone. There's something that comes after the opportunity zone, right? I mean, having in 10 years being able to have all that come back tax free, that opens up other tax strategies that are awesome. So it really does take, hey, how when are we selling this asset? When are we selling this asset? What are we putting the opportunity zone in? Does it qualify? What are we doing after we get that money out? Real quick, I think this will be the last question we have time for, but the same person who asked about the 180 days, they're saying, hey, what if the 180 days puts you into next year, right? So if they're to sell December 1st and
Sure.
then invest in February 1st, which tax year are they going to fall under?
Sure. So they'll still be in the 2022 tax year, but what they'll have to do is file an extension to file their applicable tax return, so they can then document the opportunities on investment they made within a 180-day period on their form 8949 for the 2022 tax year.
Okay, perfect. And then they just have to realize that or realize that in 2026.
Correct.
Okay. If to give that person some more direct, I don't want to say advice, but just good CPA, working with a good CPA, who's knowledgeable about this. It's really about forming that team around you to say, hey, CPA, this is what we're looking at. All the team around you, right, needs to be very, very in the know about what your situation is before just going off and gunslinging. So, yes, hopefully that answered that one thoroughly. On that 180 days topic.
I believe that's all the time that we have for a question. Unless we have any more, let me just look really quickly that we haven't been able to cover. If we haven't been able to cover your question, go ahead and leave your contact information as well, and we're happy to reach out to you after today's event to address those. So again, I want to thank our attendees for being here. Look for a link to a replay soon of this event in your email, and you're welcome to share that with friends, family, or fellow investors. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer our free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. And again, we want to thank Mark and Joseph for being here. Appreciate your expertise in talking to our attendees. And thank you again from Advice Chaser for coming. We will see you at another webinar soon. Goodbye, everyone.
Thank you.
Thank you.